Welcome back to the deep dive. Today we're digging into a really classic turnaround story. It's the Q4 fiscal year 2025 earnings call for Good Times Restaurants. That's ticker GPIM.
Right. And for anyone not familiar, they run two pretty different concepts.
Yeah.
You've got the Good Times quick service chain and then the more casual dining Bad Daddy's Burger Bar.
Exactly. So let's set the stage. The quarter was, well, it was rough.
It was painful, frankly. We saw some severe margin compression, traffic weakness. But the real story here, the thing that we need to unpack, is how management just immediately pivoted on the call.
They didn't dwell on it at all.
Not at all. They just aggressively pitched this reset and rebuild strategy. The whole thing was focused on sequential improvement for FY 2026. So the core tension for you as you listen is trying to figure out if that optimism is actually backed by sustainable changes or if it's, just wishful thinking.
That's our mission today. So let's start with the market. I find it fascinating that the stock was actually up before the news even hit. It closed the regular session up 4%. What does that tell you?
It signals that investors had already priced in the disappointment. They were betting on the narrative, on the forward-looking story.
So they were basically saying, we know Q4 was bad, just show us the roadmap out.
Precisely. But then we saw a little bit of a give back in after-hours trading once the actual numbers dropped.
Okay.
Which confirms that, investors like the strategy, but now they're firmly in a show-me-the-proof mode. The stock is just exceptionally sensitive to execution right now.
All right, let's get into those hard numbers. Give us the snapshot. What was the disappointment the market was bracing for?
Well, the top line was soft. Revenue came in at $34 million. That's a 5.1% decrease year over year.
Okay.
GAAP EPS was pretty much break even, $0.00 per share.
Yeah.
But, EPS really obscures the real pain here. You have to look at profitability.
EBITDA.
Exactly. Adjusted EBITDA plunged into negative territory. Negative $74,000.
Wait, hold on. I want to underline that. They went from a positive adjusted EBITDA of what, 1.3 million last year?
1.3 million in the prior year quarter, yeah.
To negative 74,000. That is a massive, massive reversal in performance. That doesn't happen just because sales were a little soft, does it?
Oh, absolutely not. A drop that dramatic just screams labor deleverage and commodity shock. It was a major profitability squeeze.
And that was driven by falling traffic.
Falling traffic across both brands. Good Times same-store sales fell 6.6%. Bad Daddy's was down 4.6%. When traffic falls that hard, all your fixed costs just death. They certainly eat up a much, much bigger piece of your revenue.
Okay, let's break those costs down. Management pointed to a triple threat. First, let's talk input inflation. Beef obviously is huge for both brands.
Right. They cited record high ground beef and protein costs. You've seen it at the grocery store. It's hitting everyone. But for a beef-centric company like GTM, it's an existential threat.
And you see that in the food and beverage costs.
Immediately. At Bad Daddy's, F&B costs rose 40 basis points year over year to 31.6% of sales.
And I just want to clarify for everyone listening, when we say 40 basis points, we mean 0.4%. It sounds small, but in this business, with these razor-thin margins, every single basis point can be catastrophic.
It is. It's huge. And at Good Times, the quick service side, it was even worse. F&B costs jumped a full 120 basis points, up to 32.1% of sales.
Wow.
Yeah, that just shows you how sensitive that QSR model is to commodity prices, especially when you don't have the pricing power of it. At McDonald's.
So beef prices are hammering their gross margin, then sales volume drops, and that triggers threat number 2, labor deleverage. Can you explain why lower sales suddenly make your labor so much more expensive?
Sure. Think of it this way. You need a minimum number of cooks, servers, cashiers just to open the doors. It doesn't matter if 50 people walk in or 100.
It's a fixed cost, basically.
It's a relatively fixed cost. So when your traffic drops by 5 or 6%, those same labor hours become much less productive. They're just generating less revenue per hour.
And the numbers really show that.
They absolutely do. Labor costs just soared. At Bad Daddy's, labor hit 35.7% of sales. That's a 140 basis point jump. Good Times was even worse, up 200 basis points to 35.9%.
So you've got food costs around 32%, labor around 36%.
Right. When those two things are eating up 2/3 of every single dollar that comes in, there's nothing left for profit.
Which brings us to the restaurant level operating profit margin. Bad Daddy's compressed from 13.2% down to 9.9%. Just for context, what's a healthy margin in that space?
Well, 13% is strong. That signals really efficient execution. But dropping below 10% down to 9.9, that tells you the restaurant is struggling to cover its own costs, marketing, repairs, overhead. They have to get that number back up into the 11 to 12% range and fast.
And as if that wasn't enough, they also mentioned a third threat, regulatory headwinds.
Yeah, and this is the critical forward-looking pressure. They specifically called out the Colorado minimum wage hike coming in January. It's going up to $15.16 an hour.
That's a 2.4% increase.
And a 3% increase for tipped minimum wage. So this is a headwind that's going to hit their costs next quarter no matter what they do. They literally have to run faster just to stay in the same place.
Okay, so Q4 was a reckoning. Let's pivot now to the part that actually got the market excited, the reset and rebuild strategy. What tangible proof of a turnaround did they actually point to?
Their key defense was sequential improvement. It kept talking about green shoots that they're already seeing in Q1 of fiscal 26.
So the quarter we're in right now?
Exactly. For good times, the same-store sales decline through the first 11 weeks of Q1 was only 3.6%. Now, that's a huge 240 basis point sequential improvement from where they were.
And bad daddies?
Even better, down only 1.6% in that same period. And they noted the biggest improvement was in their Colorado restaurants, which is where they'd been struggling the most.
That sequential rebound, it sounds good. But how much of that is just seasonality versus, actual strategic repair?
That is the million-dollar question, isn't it? But seeing the improvement concentrated in their struggling Colorado market suggests that some of their operational fixes might actually be starting to work. The market, for now, is giving them the benefit of the doubt.
Okay, so that strategy hinges on their pricing. They said they're averse to discounting, which makes sense. It crushed them. So how are they handling it?
They are trying to thread an incredibly fine needle here. Management said very explicitly they do not expect any significant broad price increases over the next 6 months.
Really?
Yeah. Instead, it's all about modest, targeted adjustments. They're looking at only a 1.7% average price increase at Bad Daddy's in Q1. The whole strategy is to hold the line on price and re-earn that premium through quality.
But to hold prices while your costs are still rising, your execution has to be, perfect. What levers are they pulling at good times to make that happen?
They're leaning into their identity with this Colorado Native Burgers ad campaign. But the really critical shift, operationally, is a move to a true cook-to-order process for all their burgers.
Cook-to-order sounds great for quality, but that's a huge operational risk in quick service, isn't it? It could slow everything down.
It could. That's the trade-off. It's an investment in product quality to justify not discounting. And to offset that risk, they're overhauling how they deploy labor. They're realigning GM schedules to match peak dinner and late night hours.
So the GMs are on the floor during the busiest times instead of in the back office.
Exactly. They're focused on execution when it matters most for profitability.
Okay, that makes sense. Now, shifting to Bad Daddy's, the casual dining side, how are they simplifying their traffic engine?
They're moving to a much simpler, repeatable marketing platform. It's called the Burger of the Month, and it starts in March.
A page from the big chain playbook.
A bit, yeah. It replaces a bunch of scattered promotions with one consistent traffic driver. And they're also looking at successful LTOs, like a giant Bavarian pretzel and a chocolate cookie cheesecake, and seeing if they can become core menu items. It's all about high-margin, repeatable items.
But does that Burger of the Month add a lot of complexity for the kitchen staff? That seems like a risk.
It absolutely does. Every new burger risks execution failure, waste, supply issues. But look, when you're facing a 4.6% same-store sales decline, you need a compelling reason for people to come back. The bet is that they can manage that complexity through better training.
And what about on the corporate side? Any cost cutting there?
A clear tightening of the belt. They guided for G&A expenses to be reduced to a range of 6 to 7% of total revenues in FY 2026. And this is important. The company finished the quarter with $2.6 million in cash and $2.3 million of long-term debt.
Wow, that is a tight liquidity situation.
Very tight. It just reinforces the extreme urgency here. They do not have a cushion to absorb any more missteps.
So let's connect all this to the bigger investment picture. This is obviously a high-risk, high-reward story.
Enormous stakes. The stock is down almost 50% over the last year, while the rest of the consumer sector was up. That performance gap is massive. Credibility now hinges entirely on converting those green shoots into hard reported numbers in Q1.
And because it's a microcap stock, there aren't a lot of analysts covering it, right?
Right. There's no big sell-side footprint, no widely published consensus estimates. And what that means is the stock is incredibly reactive to the actual results. The management narrative bought them some time, but now the operations team has to deliver.
So the main catalyst is just the next earnings report.
It's the Q1 print, confirming that sales improvement and critically translating it into a positive adjusted EBITDA number.
So what's the core takeaway for you, the person listening to this deep dive?
It's that this shows the painful reality for small restaurant chains right now. GTM is trying to escape this value trap. They're avoiding discounting, but they're facing brutal inflation and mandated wage hikes. Success requires absolutely perfect execution.
It is an uphill climb. They've signaled a clear change in direction away from just hiking prices and toward execution. We're in a wait-and-see mode now.
Agreed.
Okay. We've mapped out the challenges and the strategy. Now for the fun part. Let's put on our asymmetric setup hats. How does all this volatility translate into a potential trade idea? And this is our reminder. We are analysts, not financial advisors. This is not investment advice.
Right. So we're looking for high leverage situations.
Okay.
And given the extreme deleverage in Q4, specifically from those record high protein costs and management's confidence, there's an interesting scenario here.
Lay it out for us.
The trade pitch would be a short-term long position ahead of the next earnings print. But, and this is a big, it's contingent on one key factor. External data showing that beef and protein costs have actually come down from their peak in Q4 into the current quarter, Q1.
And why is that commodity relief so powerful for GTM specifically?
Because their starting point for adjusted EBITDA was so incredibly low, negative $74,000. So if they can hold their pricing line, which they said they would, while getting relief on their single biggest variable cost, the margin recovery could be, well, exponential.
You're talking about pure operating leverage.
Exactly. Once their fixed costs are covered, every extra dollar from sales or cost savings drops almost directly to the bottom line. You combine slightly better traffic with any major commodity relief, and the leverage from that low base is just massive. And the stock's underperformance gives it a huge runway if the story holds for even one quarter.
So it's a high conviction, short-term bet on protein deflation and operational execution.
That's the setup. Risky, but the leverage is there.
Okay, to recap our deep dive, Q4 was objectively painful. Negative EBITDA, huge cost pressures. But management laid out a very clear roadmap for recovery.
A roadmap driven by better traffic, targeted pricing, and a huge commitment to operational execution.
The market bought the story, but now the focus is entirely on Q1.
Absolutely. Execution is everything.
So here's a final provocative thought for you to chew on. The Q4 call was a reset. But considering that tight liquidity, that $2.6 million in cash versus $2.3 million in debt, and with those wage hikes looming, how fast can they actually execute this shift to re-earning a premium before macro pressures force them to just raise prices anyway and undermine the whole strategy?
They are absolutely racing against the clock. Speed is everything.
Thank you for joining us for this analysis of Good Times Restaurants. Remember, the information discussed here is for educational purposes only and is not investment advice.